Foreign exchange reserves, often just called Forex Reserves, are a country's financial safety net. They are assets held by a central bank like the Reserve Bank of India in foreign currencies. These assets mostly include major global currencies such as the US dollar, euro, British pound, and Japanese yen. Besides currency, they also include gold, special drawing rights from the International Monetary Fund, and a reserve position with the IMF. Think of it as a national emergency fund, but instead of being in rupees, it is held in currencies that are accepted worldwide for international transactions, making it crucial for a country's economic stability and its interactions with the rest of the world. The primary purpose of these reserves is to ensure that a country can meet its international obligations. This includes paying for its imports, like crude oil, machinery, and electronics, and servicing its foreign debt. A healthy level of reserves gives confidence to global investors and credit rating agencies. It signals that the country is financially stable and can handle unexpected economic shocks without defaulting on its payments. This confidence is vital for attracting foreign investment, which in turn helps fuel economic growth, create jobs, and improve infrastructure. Without sufficient reserves, a country can find itself vulnerable to global economic pressures and market volatility. India's journey with its Forex reserves is a powerful story of economic transformation. From a position of extreme vulnerability just a few decades ago, the nation has built one of the largest Forex stockpiles in the world. This journey reflects the shifts in India's economic policies, its growing integration with the global economy, and the strategic management by the Reserve Bank of India. Understanding this evolution helps us appreciate the resilience of the Indian economy today. The size of these reserves is not just a number on a balance sheet. It is a testament to the country's progress and a critical tool for navigating the complexities of the global financial landscape. This essay will trace the path of India's Forex reserves from the early days after independence in 1947 to the record highs seen in 2025. We will explore the critical moments that shaped this journey, such as the balance of payments crisis of 1991, the subsequent economic reforms that opened up the economy, and the steady accumulation of reserves in the 21st century. By examining the key milestones, the role of the Reserve Bank of India, and the factors influencing the reserves, we can gain a clear understanding of India's economic strength and its outlook for the future, looking ahead to the year 2030. In the decades following its independence in 1947, India adopted a cautious and inward-looking economic model. The government maintained strict control over foreign exchange through regulations like the Foreign Exchange Regulation Act of 1973. This law was designed to conserve the country's limited foreign currency reserves by severely restricting international trade and capital flows. The focus was on self-sufficiency and import substitution, which meant that earning foreign currency through exports was not a primary policy goal. As a result, India's Forex reserves remained consistently low throughout this period, rarely exceeding a few $1 billion, which was just enough to cover a few months of essential imports. The economic philosophy of this era was rooted in the belief that a closed economy would protect domestic industries and prevent the drain of precious foreign currency. However, this approach also stifled growth and innovation. The License Raj system created a complex web of permits and regulations that made it difficult for businesses to operate efficiently, let alone compete on a global scale. Exports stagnated, and the country remained heavily dependent on imports for critical goods like oil and technology. This dependency, coupled with low export earnings, created a persistent structural weakness in India's balance of payments, keeping the Forex reserves in a precarious state for nearly 4 decades. Throughout the 1970s and 1980s, India faced several minor balance of payments scares, but the underlying problem was never fully addressed. The government often resorted to short-term solutions, such as borrowing from the International Monetary Fund, to tide over temporary difficulties. The reserves would hover at levels that were considered barely adequate, providing very little cushion against external shocks. Any unexpected event, like a sudden spike in global oil prices or a poor monsoon affecting agricultural output, could quickly push the economy to the brink of a crisis. This period was characterized by a constant struggle to manage a fragile external account with very limited financial buffers. By the end of the 1980s, the situation had become unsustainable. A combination of rising fiscal deficits, increasing external debt, and political instability set the stage for a major economic meltdown. The Gulf War in 1990 to 91 was the final trigger. It caused a sharp rise in oil import bills and a decline in remittances from Indian workers in the Middle East. Global credit rating agencies downgraded India, making it nearly impossible for the country to borrow from international markets. The carefully managed but fragile system of the past was about to collapse, leading to the most severe economic crisis in India's independent history. The year 1991 marks a watershed moment in India's economic history. The confluence of domestic and international pressures pushed the country into a severe balance of payments crisis. By mid-1991, India's Forex Reserves had plummeted to a shocking low of around $1 billion. This amount was barely enough to cover 3 weeks of essential imports. The country was on the verge of defaulting on its international debt obligations for the first time. The situation was so dire that the government was forced to take emergency measures, including physically airlifting 47 tons of its gold reserves to the Bank of England as collateral to secure a loan from the International Monetary Fund. This crisis was not a sudden event, but the culmination of years of flawed economic policies. The closed economy, high tariffs, and extensive government controls had made Indian industries uncompetitive. The government's consistent spending beyond its means led to large fiscal deficits, which were often financed by borrowing from the Reserve Bank of India. This, in turn, fueled inflation and eroded the value of the rupee. The external shock of the Gulf War simply exposed the deep-seated structural weaknesses that had been building up for decades. The crisis was a stark reminder that an economy cannot remain isolated from the world and that fiscal prudence is essential for long-term stability. The response to the crisis was swift and transformative. Under the leadership of Prime Minister P.V. Narasimha Rao and Finance Minister Manmohan Singh, India embarked on a program of comprehensive economic reforms. The government devalued the rupee to make exports more competitive, dismantled the complex license Raj, and began opening up the economy to foreign trade and investment. The restrictive Foreign Exchange Regulation Act was eventually replaced by the more liberal Foreign Exchange Management Act, which shifted the focus from conserving foreign exchange to managing it. These reforms were designed to integrate India into the global economy and unleash its productive potential. The immediate goal of the reforms was to stabilize the economy and rebuild the Forex Reserves, but their long-term impact was far more profound. They marked a fundamental shift in India's economic ideology, moving away from state control towards a market-oriented system. The crisis of 1991, though painful, served as a crucial wake-up call. It forced policymakers to abandon the protectionist policies of the past and embrace a new path of liberalization, privatization, and globalization. This new direction laid the foundation for the remarkable growth in India's Forex Reserves and its overall economic resurgence in the decades that followed. The economic reforms initiated in 1991 began to bear fruit almost immediately. The new liberalized policies created a more favorable environment for both trade and investment. Lowering tariffs and dismantling import controls encouraged businesses to look beyond the domestic market, leading to a steady increase in exports. Simultaneously, opening up sectors like telecommunications, software, and finance to foreign direct investment brought in a significant inflow of foreign capital. This dual boost from rising exports and capital inflows started the process of rebuilding India's depleted Forex reserves. The sense of crisis slowly gave way to a newfound confidence in the Indian economy. By 1997, just 6 years after the crisis, India's Forex reserves had recovered significantly, growing from the perilous low of $1 billion to a more comfortable level of around $7 billion. This was a clear sign that the reforms were working. The focus had shifted from merely surviving to building a sustainable buffer against future shocks. The introduction of the Foreign Exchange Management Act in 1999 further solidified this new approach. FEMA was designed to facilitate external trade and payments and to promote the orderly development of the foreign exchange market in India, a stark contrast to the restrictive nature of its predecessor, FERA. The late 1990s also saw the rise of India's information technology services sector. Companies like Infosys, Wipro, and TCS began to make their mark on the global stage, earning substantial amounts of foreign currency through software exports. This IT boom became a powerful engine for Forex accumulation. The earnings from services exports provided a stable and growing source of dollar inflows, complementing the capital flows from foreign investors. This diversification of forex sources was crucial, as it made the reserves less dependent on any single factor and more resilient to global economic fluctuations. The period from 1991 to 2000 was one of transition and consolidation. The reforms not only saved India from a default, but also set it on a path of higher growth and greater economic stability. The lessons from the 1991 crisis were deeply ingrained in the minds of policymakers. The importance of maintaining adequate forex reserves was now a cornerstone of India's economic strategy. The country had successfully moved from a position of extreme vulnerability to one of emerging strength, with a solid foundation of reserves that would continue to grow impressively in the new millennium. The new millennium, really marked an era of unprecedented growth for India's forex reserves. The momentum that started building in the late 1990s just accelerated thanks to robust capital inflows and a booming services sector. In 2004, India's forex reserves crossed the landmark figure of $100 billion for the very first time. That was a huge psychological milestone, honestly, symbolizing the country's complete recovery from the 1991 crisis and its arrival as a significant player in the global economy. The strong reserve position gave the RBI much greater flexibility to manage the exchange rate and absorb external shocks, which boosted confidence among international investors and led to even more capital inflows. This rapid accumulation kept going through the mid-2000s. Strong global growth, along with India's really compelling economic story, attracted a flood of foreign investment, both direct or FDI and portfolio, or FPI. The Indian stock market soared, and multinational corporations lined up to invest in the country's growing consumer market. By 2008, the reserves had swelled to over $300 billion. This massive war chest proved absolutely invaluable when the global financial crisis hit later that year. As foreign investors pulled money out of emerging markets, the RBI was able to step in decisively, selling nearly $35 billion from its reserves to prevent a sharp and disorderly depreciation of the rupee. The experience of the 2008 crisis really reinforced the importance of maintaining a large forex buffer. While other emerging economies struggled, India managed to navigate the turmoil with relative stability, thanks to its substantial reserves. In the aftermath of the crisis, the RBI continued its strategy of cautious accumulation. A notable move during this period was the purchase of 200 tons of gold from the IMF in 2009 for about $6.7 billion. This decision was actually part of a broader strategy to diversify the reserve assets away from a sole reliance on the US dollar and to increase the share of gold, which is generally considered a safe haven asset during times of global uncertainty. The decade from 2010 to 2020 saw the reserves continue their upward march, crossing several more significant milestones. In June 2020, right in the middle of the global disruption caused by the COVID-19 pandemic, India's forex reserves surpassed the $500 billion mark. Just a year later, in June 2021, they crossed the $600 billion threshold. This rapid increase, even during a global health crisis, was driven by a surge in foreign portfolio investment, strong FDI, and a rare current account surplus. By the end of this period, India had firmly established itself as one of the top 5 countries in the world in terms of forex reserve holdings. The period from 2024 to mid-2025 has been characterized by both record highs and significant volatility for India's forex reserves, reflecting the dynamic nature of the global economy. The reserves have really been on a sort of roller coaster ride, showcasing the RBI's active management in a pretty complex environment. In March 2024, the reserves climbed to a strong position of $642.63 billion. This upward trend continued, culminating in an all-time high of $704.89 billion on September 27, 2024. This historic peak was a testament to the strong capital inflows and the overall positive sentiment towards the Indian economy, placing India in an exceptionally strong external position. However, this peak was followed by a period of decline as the RBI intervened in the currency market to support the rupee against a strengthening US dollar and global uncertainties. By the end of December 2024, the reserves had fallen to $640.28 billion. This intervention is a core part of the RBI's mandate to curb excessive volatility and ensure stability in the currency market. The central bank sells dollars from its reserves when the rupee is under pressure and buys dollars when there are strong inflows, thereby smoothing out sharp fluctuations. These actions naturally lead to changes in the headline reserve numbers from week to week. The first half of 2025 has seen this pattern of fluctuation continue. After dipping in early 2025, the reserves began to climb again, reaching $690.62 billion in mid-May. As of the latest data for the week ending June 6, 2025, India's Forex Reserves stood at a healthy $696.65 billion, just shy of the record high. The components of these reserves showed a broad-based increase, with foreign currency assets rising to $587.68 billion and gold reserves increasing to $85.88 billion. These weekly movements are closely watched by market participants as they provide insights into the RBI's currency management strategy and the direction of capital flows. These recent trends highlight the delicate balancing act the RBI performs. While the headline reserve number is robust, factors like the RBI's forward dollar positions can affect the effective import cover. For instance, in January 2025, large forward positions reduced the import cover from 10.7 months to a still comfortable 9.4 months. Events such as uncertainty over U.S. trade policies in May 2025 also prompted RBI action. The central bank's readiness to use its reserves to manage such situations underscores their critical role as India's primary defense against external shocks in an increasingly interconnected and unpredictable world. The Reserve Bank of India, or RBI, is the custodian of the country's forex reserves, and its management strategy is guided by the principles of safety, liquidity, and returns in that order. The foremost priority is to ensure the safety of the principal amount. This means investing the reserves in highly secure assets, primarily sovereign bonds of countries with top credit ratings, like US Treasury bills. The second priority is liquidity, which means the assets must be easily convertible into cash at short notice to meet any unforeseen payment obligations or to intervene in the currency market. Only after these two conditions are met does the RBI consider earning a reasonable return on its investments. One of the most visible roles of the RBI in managing reserves is its intervention in the foreign exchange market. The RBI does not target a specific level for the rupee. Instead, it aims to manage volatility. When there are large capital inflows that cause the rupee to appreciate sharply, the RBI buys dollars from the market, which adds to the forex reserves. Conversely, when capital outflows put downward pressure on the rupee, the RBI sells dollars to cushion the fall. This managed float regime really helps to provide a stable and predictable currency environment for businesses involved in international trade and investment. The composition of the reserves is also a key aspect of the RBI's management strategy. While the bulk of the reserves are held in foreign currency assets, dominated by the US dollar, the RBI has been gradually diversifying its holdings. It holds assets in other major currencies like the euro, pound sterling, and yen to mitigate risks associated with fluctuations in any single currency. Furthermore, the RBI has steadily increased its gold holdings. As of June 2025, gold reserves stood at nearly $86 billion, providing a hedge against inflation and global economic uncertainty, as gold often performs well when other financial assets are struggling. Beyond market interventions, the adequacy of reserves is a constant focus for the RBI. The central bank uses several metrics to assess whether the reserve levels are sufficient. The most common metric is the import cover, which measures how many months of imports the reserves can finance. As of mid-2025, India's reserves cover over 11 months of imports, well above the traditional benchmark of 3 months. Another important metric is the ratio of reserves to external debt, which stood at about 96% in early 2025. This strong coverage provides a powerful buffer against external vulnerabilities and reinforces India's sovereign creditworthiness on the global stage. Despite the comfort provided by a large stockpile of forex reserves, India faces several risks that could impact their levels. A primary risk stems from global economic volatility. A sudden global recession or a financial crisis could lead to a rapid outflow of foreign portfolio investment from the Indian stock and bond markets. This is often referred to as a sudden stop in capital flows. In such a scenario, the RBI would need to sell a significant amount of its dollar reserves to prevent a free fall of the rupee, which would lead to a sharp depletion of the forex kitty. The pace and scale of such outflows can be unpredictable and honestly quite challenging to manage. Another significant risk is related to commodity prices, particularly crude oil. India is one of the world's largest importers of crude oil, and its import bill is highly sensitive to global price fluctuations. A sharp and sustained increase in oil prices would widen the country's trade deficit, meaning more dollars would be needed to pay for imports. This would put downward pressure on the rupee and could force the RBI to draw down its reserves to meet the higher demand for foreign currency. Geopolitical tensions in the Middle East or other major oil-producing regions remain a constant source of uncertainty for India's external account stability. On the other hand, there are significant opportunities that could further bolster India's forex reserves. The Make in India initiative and the production-linked incentive schemes are aimed at boosting domestic manufacturing and increasing exports. Success in these areas, particularly in high-value sectors like electronics, pharmaceuticals, and automobiles, could lead to a structural improvement in India's trade balance. A sustained increase in exports would generate a steady stream of foreign currency, reducing the country's reliance on volatile capital flows and providing a more stable foundation for reserve accumulation over the long term. Furthermore, India remains an attractive destination for foreign direct investment. Its large and young population, growing middle class, and ongoing economic reforms make it a compelling market for global corporations. As India continues to improve its ease of doing business and invests in infrastructure, it can attract even more stable long-term FDI. These capital inflows not only add directly to the forex reserves, but also bring in new technology, create jobs, and enhance the productive capacity of the economy. Seizing these opportunities will be key to strengthening India's external position and ensuring the continued growth of its financial shield. Looking towards 2030, the outlook for India's forex reserves appears broadly positive, though subject to the dynamic interplay of global and domestic factors. Assuming a stable global economic environment and continued policy focus on macroeconomic stability, it is reasonable to expect the reserves to continue their gradual upward trend. The key drivers will remain consistent strong inflows of foreign direct investment, steady growth in services and goods exports, and the RBI's prudent management of capital flows. By 2030, it is plausible that India's forex reserves could comfortably range between $800 billion and $1 trillion, solidifying its position as a global economic powerhouse. The path to this target will be influenced by several key factors. The success of India's manufacturing push and its ability to integrate more deeply into global supply chains will be critical. If India can successfully capture a larger share of global trade, particularly in emerging sectors, the resulting export earnings would provide a powerful tailwind for reserve accumulation. Additionally, India's growing digital economy and its leadership in IT services will continue to be a reliable source of foreign exchange. The stability of capital flows will also depend on India maintaining its appeal as an investment destination through consistent and predictable policymaking. However, the journey will not be without its challenges. The global financial system is prone to periodic bouts of volatility, and geopolitical risks are ever present. The RBI will need to remain vigilant and ready to use its policy tools, including its forex reserves, to navigate any potential storms. The transition to greener energy sources globally could also impact India's import bill and external balance in complex ways. The central bank's strategy of diversifying its reserve assets, including holding a significant portion in gold, will continue to be a crucial element in mitigating these risks and ensuring the long-term stability of the reserves. In conclusion, India's forex reserves have come a long way from the crisis of 1991 to the record highs of 2025. They are no longer just a buffer against crises, but a symbol of the nation's economic strength and resilience. The journey ahead towards 2030 will require careful navigation, but the foundation that has been built is strong. By continuing to focus on structural reforms, promoting exports, and attracting long-term investment, India can ensure that its financial shield not only remains robust, but also continues to grow, supporting the country's ambitions for sustainable and inclusive economic development in the coming decade.